Hello everyone. Let's talk today about accounts receivable, and the first part of the lecture is working capital, cash to cash cycle, discounts and penalties. So first of all, working capital. It's a very important concept because it shows how the company manages its cash flow, manages its cash. Working capital is defined as the difference between current assets and current liabilities. We include in current assets cash, inventory, and accounts receivable. And in current liabilities, we include accounts payable, but not only accounts payable, but also overdraft. Overdraft is such situation with your bank account that there is zero balance, but still the bank provides you some form of credit and you can use your bank account and pay your bills even if the balance in the bank account is negative. So in other words, the bank is paying for it, but later on, of course, you have to pay back to the bank that amount. Uh, Unless the bank can offset your negative balance in overdraft against some other balances in accounts that you have with that bank. Unless you have this situation, the overdraft would be considered as liability because clearly it's a negative balance in cash. It cannot be asset, only liability. So why we need to know the working capital concept? Because as I said, it's showing how the company is managing cash, and for company it's better if the cash is managed efficiently. So in other words, the accounts payable are paid as slowly as possible, but accounts receivable are obtained as soon as possible, as quick as possible. And also there are not too many inventories, because if there are too many inventories, it means you have paid for these inventories and they are tied in the business without earning any cash for you. And of course, managing working capital well means that there are few uncollectible debts, and the debtors pay the debts quickly, but you pay your debts slowly. So all these are the conditions for efficient management of working capital. Uh, and cash, as you know, cash is the king, and we need cash for all sorts of purposes: to pay dividends, to pay various expenses, to pay the bank loan, and so on. So let's look at cash to cash cycle. It basically shows how you manage the working capital. So cash to cash cycle equals accounts receivable turnover expressed in days plus inventory turnover expressed in days minus accounts payable turnover expressed in days. And so the high figure in the cash to cash cycle indicates that we are slowly collecting cash, and that's why we're not managing our working capital well. And in contrast, the favorable figure, the low figure in cash to cash cycle, indicates that we are collecting cash fast enough, and this is good for our company. When I say figure, it means the number of days in cash to cash cycle. We express everything in terms of days. So how do we calculate? So accounts receivable turnover, it can be in times or in days, times during the year or days. 365 days a year divided in denominator we have net credit sales divided in turn by average accounts receivable. To get average accounts receivable, you need to have two figures for accounts receivable for this year and for the previous year from the two balance sheets. And same applies for average inventory and for average accounts payable. But when we find inventory turnover in days and accounts payable turnover in days, we have to divide 365 by cost of sales and then by average inventory. And same here, 365 by cost of sales, cost of goods sold, divided by average accounts payable. So we need to have a short cash to cash cycle as possible. In general, the metric, the indicator, looks at the amount of time needed to sell inventory, the amount of time needed to collect receivables, and the amount of time needed to for our company to pay the bills without incurring any penalties. Okay, example. So there is Fletcher company. Just a moment. So there are sales, cost of goods sold, the receivables, payables, and inventory. And of sales, 85% are made on credit. So we need to calculate inventory turnover, receivables, payables turnover, and find the cash to cash cycle in days and interpret the figure. So that's what we do here in slide 6. So we divide, first of all, we multiply the total sales by credit sales. After that, we divide these credit sales by the average accounts receivable over 2 years. We get figure accounts receivable turnover in times, but we want to get it in days, so we divide 365 by times and we get 60 days, the average turnover in accounts receivable. For inventory turnover and for accounts payable turnover, here in numerator we put cost of goods sold, and in denominator the average inventories, average payables. We get times, then divide 365 by times, and we get the inventory turnover 80 days and accounts payable turnover 49 days. Clearly we can see that inventories are moving very slowly. And as a result, we have a lot of inventories in the warehouse staying with the company. And so we paid money, paid cash for inventory. Inventory is not earning us any cash yet. It's just staying mortified like dead, staying in the warehouse. And it's not good. So that figure must be decreased. There should be better. Probably the company needs to introduce a better system for management inventory or implement just-in-time inventory management where supplies are delivered just at the moment of production, not before or beforehand. Accounts receivable turnover 60 days, but accounts payable turnover 49 days. For more efficient management of working capital should be the opposite. Accounts receivable turnover should be 49 days or faster, and accounts payable should be longer. In other words, we are too generous with our customers, allowing them to pay accounts slowly, but on the other hand, we try to pay our accounts to suppliers as fast as possible. It should be the other way around. So therefore, the company does not managing cash well, should have more cash at hand. Then, what do we do if the debtors are not paying on time? And how many days should we give them to pay their accounts? So obviously, if they pay fast, first of all, we set the particular date. If they pay before that date, they will get discount. So it is incentive for them to pay faster. If they do not pay on time, then we charge them penalty, the interest. So that's why we talk about discounts and penalties. So let's look at two sides of it. So discounts allowed and discounts received. So discounts allowed means that we allow our customers the discounts if they pay fast. And discount received means that we receive the discount from our creditors, from those to whom we should pay. So the left-hand side of the slide relates to accounts receivable, and the right-hand side relates to the accounts payable. Remember that GST will be involved for the original transaction, sale or purchase, and for the discount allowed and received. But when the penalty is recorded, for example, we do not pay on time or they do not pay us on time, we do not record GST. So GST is not applicable for penalties. It is applicable only for the transactions and discounts and allowances and so on, and returns. So let's look at the receivables. So there is original transaction. So we sold the goods, provided the service on account, and therefore we don't get cash yet. We recognize accounts receivable. It is a current asset, therefore debit. But if we operate in the country where there is GST, the actual revenue that we earn, credit, will be smaller than accounts receivable because of the value of GST. And GST is not our asset, it is in fact our liability that must be paid to tax authorities, so we put it as liability with credit balance. How do we find this? So suppose you know accounts receivable. So you can divide accounts receivable by 1.15. If we talk about New Zealand, you get service revenue. Or you can multiply accounts receivable by 3/23 and you get GST value here. So this is original transaction. Suppose now the client pays us back. And so if they pay us back, we get cash, we debit bank, and we nullify, we eliminate accounts receivable. So now they will disappear. However, they paid on time, not only on time, but before the deadline. And that's why we have given them discount. And discount obviously will reduce the money that we receive. We are not receiving the full amount of accounts receivable, we are receiving less. So how do we find, okay, so if we know the value of accounts receivable, then we can multiply it by the discount allowed by 3% by 0.03, and we get the value of discount. But then this value of discount, for example, $30, 3% out of 100, must be split in the actual discount and the GST, and into the GST clearing, into GST. So accordingly, you can just divide by 1.15 and get that value. So what we need to remember, that discount allowed is a reduction in revenue, and therefore it is a contra revenue account. And therefore, if revenue is credit balance, then discount allowed will have debit balance. The cash received, the debit bank, will be smaller than it should be due to discount allowed. And the other asset, accounts receivable, will be cancelled. Okay. And the opposite case here. So we paid on time and we will be given the discount. And that discount will be reduction in our expense. So therefore it would be contra expense account. So if its expense balance is debit, so discount received contra expense would be credit. Let's look at original transaction. So we purchase something from our suppliers on account, so therefore we do not pay cash straight away, we recognize our liability, accounts payable. But the actual value of our expense will be smaller because of the value of GST. So therefore, if you want to find the value of expense, so you will divide accounts payable by 1.15. You want to find GST clearing, you will multiply accounts payable by 3/23. And since it is our expense, we can claim GST related to this expense from tax authorities. So therefore, this GST clearing will be our asset and the balance would be debit. The same will apply here when we actually pay. When we actually pay, our liability will be reduced and disappear. That's why we debit accounts payable, and also we pay cash. So therefore we credit bank, but we do not. This value of bank, the value of cash would be smaller than the value of accounts payable, since we received the discount. They gave us the discount. And then this discount can be split into actual discount and into GST component. All that will happen if we pay on time or they pay us on time. And therefore there will be incentive provided, discount. So we give them discount or they give us discount. What if we don't pay on time or they do not pay on time? Then there will be penalty. For penalty, there is no GST. So if our clients were late in paying, then we can get penalty from them. So therefore our accounts receivable would be increased, and simultaneously there will be additional revenue for us. It will be called interest revenue. And the opposite here. So if we were late to pay our bills, to pay our accounts, we will get additional expense, and therefore we will debit interest expense, and it would be our additional liability. So let's look at the example. Example 2. Wait a moment. Okay, so we look at XYZ company. It owes 5,175 to creditor. It receives 2% discount for prompt payment. So you find the value of the discount, 2% of the value of accounts payable. So it will be $103.5. And then you can separate the actual value of the discount received and the increase in GST liability. So you just need to divide 103.5 by 1.15, or 103.5 times 3/23. And so XYZ company paid earlier, so therefore it has received discount. Discount is a contra expense account, and therefore its balance is credit. We split this $103 into the actual discount received and GST clearing. And since there is discount, our cash expense, the payment of cash or to the supplier, to the creditor, is smaller than accounts payable. So all looks correct. Then the next example. So now we again looking at XYZ company, and now the customer owes some money. And if the customer pays quickly, within specified period of time, he gets 3% discount. So again, 3% out of 3,335 will give you $100.05. Discount allowed is a contra revenue. Of course, it would have debit balance, the opposite of revenue balance credit. So the actual discount allowed would be total discount by 1.15. So in other words, total discount includes GST, discount allowed excludes GST. And same in the previous example. Just a moment. In the previous example, so the total discount inclusive GST and discount received exclusive GST. And same here. There will be, just a moment. Just a moment. Yes, so this $100 is inclusive GST and discount allowed exclusive GST. You want to find the value of GST, so you multiply discount inclusive GST times 3/20. And so now we receive the money from the customer. That money is smaller than what he was supposed to pay because he paid earlier, faster. And therefore we given him discount. And this discount is reduction in our revenue, so therefore it has debit balance because it's a contra revenue account. So this is the first part of the lecture. Thank you.